What's going on, everyone? It's Allison, and welcome back to the channel. If you love making money passively, monthly dividend ETFs are for you. These ETFs pay dividends every month, not just quarterly. This can be a game changer for covering expenses or reinvesting. Stick around as we break down 6 top monthly dividend ETFs. Let's get started. Let's dive into the Invesco KBW High Dividend Yield Financial ETF, or KBWD. This ETF is all about high dividend yields. We're talking about a 7.37% dividend yield. That's right, 7.37%. If you had $100,000 invested, you'd get over $7,000 annually. But there's a higher expense ratio. It's 0.35%. KBWD focuses on financial stocks with higher yields. If you're bullish on finance, KBWD could be a solid choice. Now, let's take a closer look under the hood and see what KBWD is actually made of. This ETF tracks the KBW Nasdaq Financial Index, which includes a diverse range of financial companies. Think banks, insurance companies, real estate investment trusts, you name it. By diversifying across different subsectors within finance, KBWD aims to mitigate risk while still delivering those impressive dividend payouts. But here's the thing about high dividend yields. They often come from companies that are undervalued by the market or considered to be riskier investments. In the case of KBWD, the financial sector can be heavily influenced by interest rate changes and economic conditions. So before you jump in, it's crucial to do your due diligence and understand the potential risks involved. Remember, diversification is key. Don't put all your eggs in one basket, even if that basket is promising a 7.37% dividend yield. So, the big question is KBWD the right fit for your investment portfolio? Well, that depends on your individual circumstances and risk tolerance. If you're looking for a high-yield way to generate passive income and are comfortable with the volatility that comes with the financial sector, KBWD could be a good option. However, if you're more risk-averse or prefer a more diversified approach, there might be better choices out there. Remember, it's all about finding investments that align with your overall financial goals and strategy. In the next chapter, we'll explore another monthly dividend ETF that takes a global approach to high-yield investing. Stay tuned. Now, if you're looking to diversify your portfolio beyond US borders, the Global X Super Dividend ETF, or SDIV, might just be your ticket to global passive income. This ETF casts a wide net, investing in high dividend stocks from all around the world. We're talking about a portfolio of 100 of the highest yielding equity securities from across developed and emerging markets. Talk about going global. And the best part? As of today, SDIV boasts a juicy 6.83% dividend yield. That's right, nearly 7% in potential annual income just for holding this ETF. Now keep in mind that past performance doesn't guarantee future returns, but SDIV has consistently paid out high dividends, making it a popular choice for income-focused investors. But before you pack your bags and start booking flights to chase those international dividends, there's something you need to know about SDIV's expense ratio. When it comes to investing, every penny counts, right? And that's why it's crucial to pay attention to expense ratios. In the case of SDIV, it comes with an expense ratio of 0.59%. Now that might seem small, but it can eat into your returns over time. Think of it this way: for every $10,000 invested in SDIV, you'd be paying $59 in fees annually. Not exactly chump change, right? But here's the thing. SDIV's global diversification and high dividend yield might just outweigh those fees for some investors. Remember, investing in international markets comes with its own set of risks, such as currency fluctuations and geopolitical instability. It's crucial to do your due diligence and make sure you're comfortable with the potential volatility before diving in. So, is SDIV the right fit for you? Now I know what you're thinking. A 6.83% dividend yield sounds pretty tempting, right? And you're not alone. SDIV has become increasingly popular among investors seeking both income and diversification. By investing in a basket of high-yielding stocks from around the world, SDIV offers a way to potentially boost your passive income stream while reducing your reliance on any single market. But here's the thing. High dividend yields can sometimes be a red flag, especially in the case of companies or countries facing economic challenges. It's essential to remember that dividends are not guaranteed and can fluctuate depending on a company's profitability and overall market conditions. Alright, coming in at number 3, we have the Global X Super Dividend US ETF, ticker symbol DIV. Now this ETF focuses specifically on US companies, and what I like about this one is its emphasis on low volatility. See, when you're looking at dividend-paying companies, you're often looking for stability and consistency, right? You want those steady payouts coming in, and that's where this ETF shines. It targets companies with a track record of paying higher than average dividends, but it also prioritizes those with a history of stable payouts and lower price fluctuations. So, you get that peace of mind knowing that the ETF is designed to weather market ups and downs a little better, which is something I'm always a fan of. And on top of that, it boasts a dividend yield of 5.80%, which is pretty solid. Now let's dive a little deeper into what this ETF actually holds. The DIV invests in a diversified basket of about 50 US companies across various sectors. You'll find some familiar names in there like real estate companies, utilities, and energy companies. These are typically considered more stable sectors, which again, aligns with that low volatility strategy. And remember, diversification is key, people. You don't want all your eggs in one basket, and this ETF does a good job of spreading the risk across different industries. This helps to mitigate the impact of any one sector performing poorly on your overall investment. So that's a big plus in my book. Now, when it comes to the expense ratio for this ETF, it's important to factor that in. It sits at 0.59%, which means that for every $1,000 you invest, you'll pay $5.90 in fees annually. That's something to keep in mind and compare to other ETFs in this space. But before you write it off, remember that you're getting exposure to a carefully selected group of high-dividend US companies with a focus on stability. And that can be valuable, especially if you're looking for a consistent stream of income from your investments without too much volatility. As always, do your own due diligence, research the holdings, and see if it aligns with your investment goals and risk tolerance. Moving right along, let's talk about the Invesco Preferred ETF, ticker symbol PGX. Now this one's a little different because it focuses on preferred stocks. Now for those of you who aren't familiar, preferred stocks are kind of like a hybrid between common stocks and bonds. They offer the potential for growth like stocks, but also provide a fixed dividend payment like bonds. Now this ETF specifically invests in a basket of preferred stocks issued by US companies. And one of the main advantages of preferred stocks is that they tend to offer higher dividend yields compared to common stocks. That's because preferred stockholders have a higher claim on a company's assets and earnings in case things go south. So it's generally considered a bit of a safer option. Speaking of yield, the PGX ETF is currently paying out a dividend yield of 4.87%. Not too shabby, right? And it's important to note that this ETF casts a wide net, holding over 200 different preferred stocks. This diversification helps to spread the risk, which is always a good thing in my book. Remember, even though preferred stocks are considered relatively safer than common stocks, they still come with their own set of risks. So, diversification is key to mitigating those risks. Now, one thing to keep in mind with preferred stocks is that they can be sensitive to interest rate changes. When interest rates rise, the value of preferred stocks can sometimes fall. So that's something to be aware of, especially in the current economic environment. Now let's talk about the expense ratio for the PGX. It comes in at 0.52%, so for every $1,000 invested, you're looking at about $5.20 in annual fees. Again, always important to factor that into your overall investment strategy. Overall, the PGX can be a solid option for investors looking for a steady stream of income with potentially less volatility than a pure common stock ETF. It's diversified, offers a decent dividend yield, and can provide some stability to your portfolio. But remember, do your research, understand the risks, and see if it aligns with your investment goals. Number 5 on our list is the Invesco S&P 500 High Dividend Low Volatility ETF, or SPDH. This ETF provides steady dividends while minimizing risk. It focuses on S&P 500 companies with high dividends and low volatility. Earn passive income without market ups and downs. With an expense ratio of 0.29%, it offers a 3.86% yield. This ETF is all about stability. Sacrifice a bit of yield for lower volatility. Prioritize stability with exposure to large-cap companies. A reliable dividend payer that won't keep you up at night. Now let's dive into the low volatility aspect of this ETF. Volatility refers to how much the price of an asset fluctuates over time. High volatility means bigger price swings, while low volatility means smoother sailing. SPDH aims to provide more stable returns even in turbulent market conditions. This can be appealing to investors closer to retirement or those preferring a less bumpy ride. Remember, no investment is risk-free, and even low-volatility ETFs can fluctuate. SPDH focuses on companies with stable dividends and lower price swings. So, what kind of companies can you expect to find in the SPDH portfolio? Well, as the name suggests, this ETF tracks the S&P 500 High Dividend Low Volatility Index. This index selects 50 stocks from the S&P 500 with high dividend yields and low volatility characteristics. These companies come from a variety of sectors, including utilities, real estate, and consumer staples. You'll find familiar names like Coca-Cola, Johnson & Johnson, and Procter & Gamble, companies known for their consistent dividends and relatively stable performance. The SPDH's focus on large-cap, blue-chip companies can provide a sense of security for some investors. These are generally well-established businesses with long track records and strong financial positions. However, it's important to remember that diversification is key. Holding only large-cap stocks might limit your growth potential. So it's always a good idea to have a well-balanced portfolio that aligns with your overall investment strategy. Welcome to DHS, the Dividend Powerhouse. If you're looking for a dividend ETF that doesn't shy away from a little risk, DHS might be right up your alley. DHS focuses on large and mid-cap U.S. companies projected to pay high dividends. It focuses on future dividend growth potential rather than just past performance. With a yield of 3.77% and an expense ratio of 0.38%, DHS is cost-effective. DHS's strategy could be smart for long-term investors seeking growing income streams. One of the key things that sets DHS apart is its focus on dividend growth potential. Instead of just looking at companies that have paid high dividends in the past, DHS uses a forward-looking approach. It analyzes company earnings and forecasts to identify those that are most likely to increase their dividend payouts in the future. This can be a powerful strategy for investors who are looking to build a portfolio that generates increasing income over time. Of course, predicting future dividend growth is not an exact science. Companies can face unexpected challenges and market conditions can change. But by focusing on companies with strong underlying fundamentals and a commitment to returning value to shareholders, DHS aims to identify those most likely to deliver on their dividend promises. Remember, investing in dividend-paying stocks is a long-term game. It's about finding companies with sustainable business models and a track record of rewarding their investors. So, what kind of companies can you expect to find in the DHS portfolio? Well, as we mentioned earlier, this ETF focuses on large and mid-cap U.S. companies. This means you'll find a mix of well-established giants and potentially faster-growing mid-sized companies. Some of the top holdings in DHS include energy companies like ExxonMobil and Chevron, healthcare giants like Johnson & Johnson and United Health Group, and financial institutions like JP Morgan Chase and Bank of America. This diversified approach across different sectors can help to mitigate risk. By investing in a basket of companies from various industries, DHS aims to reduce the impact of any single company or sector on the overall performance of the ETF. However, it's important to note that DHS does have a higher allocation to certain sectors compared to the broader market. For example, it has a significant weighting in energy and healthcare. While this can be beneficial if these sectors perform well, it can also increase risk if they underperform. And there you have it, our top 6 monthly dividend ETFs for steady income. Remember, investing is a marathon, not a sprint. It's about finding investments that align with your financial goals, risk tolerance, and time horizon. Don't forget to like, subscribe, and hit that notification bell for more financial tips and investment strategies.